everybody to today's webinar. We are convening after quite a while. I think it's been a few months since we did our last one. Where we are at the moment in the market, we as BuyProperly thought it was important that we take stock of things overall and share it with our investors. So I'll start with a little bit of background context on our speaker and myself. So I'm Khushboo Jha. I'm the CEO of BuyProperly. We are a platform for fractional investing in real estate. We allow people to buy small shares of real estate of whatever deal they like. And we've tried to make the process as smooth as possible while staying completely compliant with all regulations as required. And the minimum is $500 for a first-time investor for their first investment, and then $2,500 after that. So it's a really low barrier for somebody to start investing in a space like real estate. And we have with us Rita Li. Rita, it's an honor to have you. Rita is a very accomplished financial advisor who's been in this space for over 15 years now. She is part of RBC. She has a CFA, MBA, and one of the smartest persons around in the industry that I've met. We've had her before on our webinar, largely because she always gives a very neutral advice, and we like that about Rita. So thank you, Rita, and welcome to our webinar.
Yeah, thanks, Khushboo. Always a pleasure to collaborate with you, and it's awesome to see you again.
Good to see you, Rita. Why don't we start by maybe setting up some context? So like, what exactly is going on in the market? I mean, we all read snippets of news and it's maybe going to go up, maybe not. Like, what is going on? How would you as a financial advisor summarize it for people who come to you? So what's going on with crime in the US and Canada? And what is the outlook looking like for the economy for the rest of the year?
Yeah, so that's one of the most common questions I get, right? Because every day you hear the news, and then it's very confusing because there are always these cross currents and things are happening everywhere in the world. So one thing to keep in mind is that the market is always forward-looking. So that's what makes time in the market so difficult for everyone, professionals as well. So we had the lowest in the market sometime last year, and because of last year's pullback, that is really in anticipation of this year's weakness. There's been a lot of talk of recession, and part of the confusion is it doesn't feel like we're in a recession and we're waiting for it. So this year so far, the market's been strong, and that again is in the anticipation of a recovery. So that's the challenging part because the fact that the market is always forward-looking, and it's not always right, it's always correcting its assumptions, but that's what's going on.
Got it.
Yeah.
Yeah, so basically things were going to be bad this year, and so they became bad last year.
Exactly, exactly. I think there was a question there on rates, and as you know, that interest rates is one of the main drivers in financial assets, the markets, real estate, everything, interest rates and credit conditions. So it is definitely really important, and a lot of it is driven by inflation expectations. I have clients asking, how come, why is the central bank raising rates? Why is that happening? And part of that is to combat inflation. For older millennials like us, Khushboo and me, we've lived through the time period where it's mostly in the deflationary time period. So very few people have the memory that when inflation is out of control, that when it starts feeding into itself, it's very destabilizing in the economy. So maybe not in Canada we've observed, but overseas in countries like Turkey, we've definitely seen that. And that's the reason why central banks are so aggressive in terms of raising rates and bring that expectation under control. And even at the risk of inducing a recession, So that's what's going on with rates. And the general expectations is that we have seen, if we haven't seen the last rate hike, we're seeing the last, we'll just have a few more, because inflation's coming down from 8 to 9% to 4 to 5%. So it is coming down. So, the risk of going too much rate hikes can be very, very damaging to the economy. So likelihood is that we've done the hard work. But what happens from here, how fast for the rate to come down has to do with things like inflation, unemployment rate, growth in GDP, things like that. So, but yeah, so does that answer your question on the rate part?
Yeah, and yes and no. So is it going to go down next quarter? What do you think?
We may see a hike actually in the next quarter, maybe, but it's likely that will hold at the high level until we see that more weakness in inflation prints.
It's already killing us. So, I mean, I feel like I'm sure mortgage holders like myself, who in hindsight was very stupid to move to a variable rate, are like,
Hindsight, right?
Yes, when does this get done? But yeah.
Yeah, I mean, on that note, we just renewed our mortgage, and it is very high. We renewed a 3-year fix, and it's close to 5%. Yeah.
Oh well. Since we are talking about interest rates, let's get to the core topic, which is investments. And how are the various markets performing this year, and what's the expectation for the end of the year? A lot of our customers, including the ones on webinar, have indicated they do want to invest maybe in the next 3 months. Like, nobody wants to commit to anything right now, but if they are looking to invest, what do you see as the outlook across the various markets? So the stock market, the bond market, and we'll talk a little bit about the private markets as well.
Okay. Yeah, so it is quite scary, isn't it? Because just not that long ago, we had the debt ceiling debate. And yes, they've always able to reach an agreement at the last hour. But,
yeah.
The chance if they don't, it can be very detrimental to the market. So I definitely understand the jitters. So like I said, in the stock market, at least the S&P 500 and NASDAQ, we've seen a strong rebound already. And that's just in the anticipation of the market's pricing in a recovery, essentially a soft landing, a mild recession and a recovery in 2024. So if that is a scenario, and we're seeing a recovery in earnings in 2024, then there is actually upside in the market currently. So it wouldn't be a bad time to start positioning, for some more equity exposure. And then within the stock market, there are different markets. The Canadian market, for example, hasn't recovered as strongly. Overseas market, different parts of Europe is in recession, but the Japanese market has been very strong this year. But it's the stock market. It's quite diverse too. On the bond side, so I've always told clients. So generally for bonds, you earn the yield that when you purchase it, the bond is yielding 4%, 5%, or 6%. That's your return. You can expect that's essentially the return that you get. So in a higher interest rate environment, it's actually quite good for bonds. And then it's a little bit complex again, because say if you had bonds before the rate increase, then you see your bond portfolio actually came down too. And there will be adjustment period in bonds adjusting to higher interest rate. But so far this year, bond market is quite good, and the U.S. market, S&P 500 and NASDAQ, quite good as well. I do have a chart in terms of what's driving the growth, the return growth in S&P and NASDAQ, and you can see that it's quite concentrated in a few names. what we name as fan stocks. So it's not quite broad. So don't be surprised if your general portfolio hasn't recovered as much if you have a diversified portfolio.
Oh, my portfolio is very heavy in tech stocks, so they are doing well.
Yes.
That part is my real estate investments are okay. A lot of them are with BuyProperly actually.
Yeah.
So they're doing okay, but my stock part of my portfolio is not happy at all. Could you share the chart you are referencing if you have it handy?
Yeah, sure. Let me see.
Yeah, and meanwhile, there is a question, Rita, I think it's for you. So for a beginner investor, would you suggest investing in US stocks? I'm a total beginner and I don't know how to get started with more risky investments. Right now, I have a hands-off approach with index funds.
Mm-hmm.
Like in general, I can't give any advice. This is a session for information only. And so I would move it over to Rita for that piece.
Sorry, I'm trying to multitask.
Sure.
This is, let me go. So this is, you know, for people that are curious in terms of, you know, diving into under the index, like the gentleman said. You know, you can see that year to date, S&P 500 is up 12%. And a lot of it's driven by the recovery in fan stocks. So that's Facebook, Apple, etc. You know, you see that strong rally, 53%. But it is very focused because most of the stocks have not participated in that broad rally. So unless you hold, you know, these stocks more heavily. Sorry, Khushboo, can you repeat that question? I caught some of it. Yeah.
Yeah, it's actually in the Q&A tab.
Oh, okay. Yeah.
So for a beginner, would you suggest investing in US stocks? Yes. I'm a total beginner and I don't know how to get started with more risky investments. Right now, I have a hands-off approach with index funds.
Yes. So index fund is a good way to gain broad market exposure. And I would say that, you know, I always remember Warren Buffett's teaching. He famously says that if you don't want to hold a stock for 10 years, then, you know, don't think about holding it for 10 minutes. So I just, you know, I want to clarify what you mean by more risky investment, because I think, you know, one of the things that I always talk about is just to develop your own investment philosophy over time. So what is your philosophy? And understanding what you're investing in is super important. Instead of taking a more speculative approach, if you're thinking about maybe just picking names and less diversified for higher return, that's great. But, you know, do the research and say that, okay, I know this industry, I know this company, I love it, and this is why. That would be my best advice. Yeah.
And then somebody's asking, would you suggest ETF bonds? We didn't talk about bonds a lot, but maybe you could talk a little bit about bonds and educate people like me who are not as much well-versed with how the bond market works and how an ETF bond would play into a portfolio. Yes.
So it's really interesting because the bond or credit market is much, much larger than the equity market. But, you know, it doesn't get as much press. Part of it is, you know, it's probably less interesting. But so when you look at bonds overall, generally, I would say that there are a couple of things. So one is interest rate. So there's the thing called yield to maturity, and that's your return, and then you want to know what that is. Duration, it's a little bit different than maturity. Say a bond matures in 3 years, its duration is slightly less between 2 and 3 years because you get the coupon return in between. And that shows you what your interest rate exposure is. And then there's the credit risk. You know, if you're in a time where you're confident in the economy, so you may want to invest in investment grade companies, bonds, or you may want to go higher risk, but for higher yield, of course. But if you're worried about the economy, so you may want to just stick to investment grade bonds. So that could be better and you feel safer. What I do with clients myself is I build bond ladders. So it's very straightforward. Say that, this portion will mature in 1 year, 2 years, 3 years, 4 years, etc. Right? If you use ETF, and I understand completely, not everyone wants to pick their own bonds. So what will happen is when you purchase the ETF, understand the yield that you're getting, and that's likelihood what your return will be. And make sure that there's good liquidity with the ETF, so you can, buy, sell easily. Yeah, I hope that answered the question. Does that make sense?
Yeah, it does make sense.
Yeah.
Cool. And so if you're talking about this slide on defensive and risk sectors and YTD performance, the obvious next question is, are there certain sectors that tend to perform better during times of market volatility? And I know it is true for real estate. There are certain sectors that do better in times of volatility than not. So for example, like a storage facility, it's like almost recession proof. Healthcare investments or medical building, it does the same, like it has no change. An office tower may be different, or a retail may be different, but there are certain sectors that always are like they may not look as attractive. Like a storage facility looks not attractive to anybody at any time. But honestly, like I feel like if I were to play safe, I would put all my money in a storage facility. We've had a few of those investments on BuyProperly, and they're high margin, recession proof kind of industries. So I know it happens specific to real estate, especially in the private market side, but what's the equivalent from your perspective on an overall portfolio? What does better with market volatility?
Yeah. I mean, I'm not a real estate expert, but even I understand that storage and industrial is being very hot and very profitable. So there are some similarities for sure. But it does depend on what's causing the volatility, because each time there's volatility in the economy, there is sometimes, a lot of times, there is a shock to the economy, like COVID, for example. But it does matter what caused it, because if it may impact different sectors at that time. But generally speaking, say that if there's time of volatility, it means that there's a time of uncertainty. And when there's a time of uncertainty, that you may just want to be more defensive. And when you look at what sectors are defensive, consumer staples, for example, and utilities. So companies that are more, predictable, versus more cyclical industries, which, that they will suffer more when there's more times of volatility, especially if there's a time where there's a higher recessionary risk. So cyclical, consumer discretionary, people may be less likely to purchase that, I want to say PS5, so yes. So generally there is, but you do want to know what caused the volatility. That does matter as well. And within different countries, there are some nuances as well. For example, the financial services sector in Canada is more defensive, versus in the US is more cyclical. So a little bit of there.
So what strategies can people employ to navigate the current uncertainty scenario? Like, how do they create their own multi-asset strategy, so to say?
Right. Yeah. So how do we tie it back? What do you do, right? Yeah. Thank you for that. So you want to have a more diversified portfolio, because no one really knows what will happen. Today, we're forecasting that it will be a milder recession, but anything could happen, right? The war between Russia and Ukraine could get worse, for example. Just things that you couldn't see, right? And so that's part of it. And the other part is that you want to position yourself for the next cycle, right? You should be forward-looking, not necessarily position for what you can see today, but you want to overweight. Say, for example, you have a view of something happening in the future. That's what you want to. That's one of the reasons why tech companies have done so well, right? because that's what people are doing.
Got it. Okay. And how do they diversify their portfolio?
Yeah, so I worked at Ontario Teachers Pension Fund, and that's one of the funds that pioneered on looking outside of just the stock market and bond, the traditional investment vehicle, and they got into private equity type of investment and more diversification. So today, individuals' portfolio can be more sophisticated, and I do have a chart somewhere here. Let me. You have a question, by the way, Khushboo.
Yes.
Yeah. Yeah. So this just shows that how Canada Pension Plan invests their portfolio, and this is relevant for everyone with CPP or expect to receive CPP in retirement. So you can see that there's a healthy amount of money that's in public equities, private equity, fixed income, real estate. And on the right-hand side, you can see that these are all the investment universe that we have access to and can talk to clients about. In the short term, there are always fluctuations and mispricings, but over the long term, generally the markets are very good at pricing risk versus return. And by risk, we just mean that the volatility that you see. So these are all the diversification that you can potentially have. And what's the right level of diversification? That's something that you need to think about yourself or chat with someone like me.
Fair enough. Just a quick question for my own understanding. The infrastructure, real estate, and credit in your chart, they are still public market, right? So the real estate, the credit, and the infrastructure in your pie chart, they're still public market. They're not private.
Some are private, some are public. Yeah.
Got it. Okay. Yeah, so we at BuyProperly attempted to do something like this. Actually, let me share this. Hang on. I will
stop sharing. Let me stop sharing.
Yeah. Okay. So we tried to do something. Can you see my screen?
Yeah.
Yeah, we tried to do this. And again, these are people anonymized, of course, that we worked with to create diversified portfolios. And the idea was to have a mix of public and private markets. And we have obviously private market data and public data, and we worked with lots of financial advisors, portfolio managers in the background. So I'm going to put some random numbers here, but like indicative of my own investment, actually, maybe. Because I have nothing in bonds. I have maybe quite a bit in cash, and my time horizon is typically long, so I'm never rushed. My diversification requirements, like you said, is not everybody's thing. Like I am not high on diversification often, especially if I'm investing in a sector that I feel I know and follow quite regularly. So I wouldn't diversify because I feel like I know the industry better. So my requirements are often low because I invest in only a select few sectors in general. Again, yeah, I look at diversity and climate, and of course, we don't want any of these. This is just us, but of course, an advisor like you can provide your own inputs in your own philosophy based on the discussions. For me, capital gains is what I often like to plan for. And since I have a lot of private real estate kind of investments, my rebalancing isn't as often. It's not a daily because it's not stock heavy. So then what it does is basically, this is my current portfolio. This is how I am spread, but the recommended portfolio is very different given how and this is often updated based on how the markets are performing at the moment. But you see the alternate investors is almost 60% recommendation because I anyways didn't have a long horizon and I don't need as much diversification. I'm looking for more alpha. So this is how it splits up. So I'm talking only about alternate. So how it would split up across the various kinds of real estate. This actually is closer to my portfolio of single family homes. And then this would compare what my risk. This is an AI model we have, by the way. It's called Artemis. We've never publicly used it, but we've used it offline with the help of our portfolio manager for clients and customers who've been interested in this. This is the recommended portfolio and current portfolio comparison. So you would see that the current portfolio and the recommended portfolio, if you look at the returns, the current portfolio has higher returns than the recommended, but the risk is significantly lower. So my returns are slightly lower, but the risk is significantly lower. And that's my preference. And then, of course, it does a split on how much in commercial, how much in, we sometimes get asked about timber and farmlands and all of that. And then how much should be in stocks, how much in industrial. And of course, then it can give you recommendations from what we have from this that will be relevant for you.
Yeah, so I'm not.
Yeah.
Yeah, so I'm not an expert in the private space and not really real estate either.
Yeah.
So I always think that whatever that you want to invest, you want to engage with someone that can provide professional advice.
Yeah.
So that's important. And try to be as transparent about your goals and in terms of not fears, but your risk tolerance as well. You know, what do you need? What's your time horizon? What's your liquidity needs? And things like that. And then, you know, come up with a plan that's suitable for you. But it's important to, you know, just talk to the right people, get the professional advice, and get the plan, yeah, for yourself.
We have yeah, that's true. I feel like sometimes, and like with all of, I majored in finance, I have an MBA, but I feel like even then, I think my knowledge on when to ask for advice and in what area, maybe it's ego, maybe it's arrogance, or maybe it's just not knowing what I don't know, that there is a bigger world out there that has so many other options than the simplified world that I'm aware of. And sometimes just not knowing that, hey, I don't even know about this, so how would I even ask? And I think through our webinars, we want to open up people's minds to say, hey, we are doing real estate deals, but remember, there is private credit, there is private equity, even in the private side, and there's the whole public market. And you have to think of all of those components, because as a platform, while we may be focused on real estate or private markets overall, the idea is that we started this because we want people to make money, like to grow their wealth, regular people to grow their wealth, which cannot be just real estate, which brings me to a question we have. We have three. So the first one is totally for you. What about dividend stocks? Are they stable?
Yes.
Yeah.
Dividend stock. So I do have some slides. Do you want me to go through them?
Sure. Let's address those questions one by one.
Okay. So let me just share my slides a little bit here. So we've gone through this slide. So dividend investing as a style has been around for a long time, right? Because then every once in a while, people will come on TV or write about dividend paying stocks and dividend growth. And the reason is it is generally more stable. And I won't say generally because there's no 100%, you know, truth, right? Like that applies all the time. But most of the time when a company is paying a good dividend is because they're more mature. So they're generating stable cash flow and then they're using, you know, let's say 50% of that they return to shareholders. So I have this slide up because I feel that, you know, people understand dividend, the importance of dividend in investing, but it's beneficial to spell it out. So for example, if you purchase a share, a stock, a company that pays 4% dividend, that's at the price of 100. So that means that the first year you get $4 back as dividend. And then by year 6, and say this company is able to grow their dividend by 5% year over year. So then by year 6, the dividend grows to, $5.11. And during this time, you will have received $27 in dividends. So that's how much of your original capital you recuperated. And if you hold it for 17 years, you recuperated your whole investment. This is not to say that, like, this is just dividend alone, and dividend you receive and they grow dividend without thinking about stock appreciation. So when you think about it that way, it's quite powerful. And just one other thing to add on that is that in Canada, dividend actually contribute to about 50% of the return on S&P TSX. It's a little bit lower in the US, it's 30%, but it's definitely a big part of your total return. So it is something to consider. So in one of our dividend portfolio, for example, on a $1 million portfolio, so if you invest in since 2014, these are the year-over-year dividend annualized that you will receive. And over this whole time period, you have received close to $400,000 in dividend income, which is quite good. So all that is to say that dividend is a big part of investing. But there are different styles. If you're someone that's more on growth and momentum, from a price appreciation point of view, the past decade have been very good for you. But if you're someone that wants to be a little bit more conservative, dividend and invest in dividend and dividend growing companies can be very, very good as well.
Yeah.
Does that answer? Yeah. Answer the follow?
Yes, you answered it, answering it sort of as advisors often do. I guess it boils down to what I want, basically.
Yeah. Yes, there are. It's our job to explain the benefits, I think. Every advisor have a different style, but I think I like to explain the pros and cons and more provide guidance.
Yeah. Which basically, I think the one takeaway I'm getting from today's session is there's a book I was reading, and again, it's whatever I say is not financial advice. I always like to put a disclaimer a few times. Whatever I say is just my personal opinion and not an advice at all. But there's a book I was reading. It was called The Psychology of Money. And I started reading it some time back because I went to this coaching session, and the discussion point was, what is your relationship with money? Like, what is your personal individual relationship with money? Often determined by how you grew up. Did you grow up in scarcity? Did you grow up in abundance? What your parents did, what your family did. Is a business family, it's an academic, professional family. All of that shapes how you think about money and how much you think is enough. And yes, there are lots of people in the financial industry who are doing large deals and seeking alpha and high risk returns, but put their money in like literally safe dividend generating investments only and grow it at maybe 5-6% a year, and that's it. And they are okay because that's what makes them sleep well at night. So it is such a weird thing. And I guess that's what you are hinting at, that it depends.
Yeah, that's kind of, I think that's a big part of why people work with advisors. I read that book as well, by the way. I really like it. Yes. I think there was one part that struck me where people have this psychological barrier where you start earning more than your parents, and then you get quite like cognitively uncomfortable about that. I don't know if that's true with everyone. Yeah. By the way, I do want to say, since you said it, generally, when I make a formal presentation, there's a disclaimer as well, and we'll put it up. But I'm not giving investment advice either on this webinar. It's a very generalized discussion. And, to know what best to do is to understand your personal situation.
Yeah, there's a question from Andrew. Thank you for those questions, Andrew. I feel a majority of people are investing in real estate and stocks. Does that make it more risky or safe due to the high level of trust compared to less conventional methods of portfolio building, such as tech, private equity, and cryptocurrencies with bigger upside. Again, we've set the stage for answer to this question. Depends what's risky and what's safe. And I use this example all the time. My husband and I both opened Wealthsimple trading accounts the same day. We said, hey, everybody's doing it in Canada. We need to try this one out. And we said, yeah, let's start with a small investment there and see how the tool works. He started by 50,000. That was everything he had in his bank account. I started with 500. We were earning the same salary, the same year, same market conditions, and same knowledge. And yet our approach to that was so different. Just starting with that tool is like not close by. And so what is risky? We both thought it was a risky and we would try. Wealthsimple is still new, but we tried at such different levels that it is forever etched in my mind. And so whether it's risky or not depends what your goals are, how well you are going to be, and how much time you're going to it. Is it hands-off? Is it hands-on? If you're thinking about conventional methods of portfolio building, such as tech, private equity, again, a portfolio is private and public, stocks, bonds, and private markets, or alternatives as they are commonly called. Within alternatives, you would have private equity, cryptocurrency, private credit, and real estate. And which one is in favor depends. Crypto may be driving a lot of upside, but should it be a large chunk of your alternative portfolio? Without knowing anything about anything, I can say probably not, because it doesn't make your portfolio safe. How much is a different question. But Rita, what do you think of that one?
Yeah, well, I think you addressed. I agree with most things you just said, and the only thing I will add is, real estate and stocks, public markets, it's well recognized and established. It's a well-established vehicle or market space or whatever that you want to call it. The only thing that make cryptocurrency is more, it has less history, right? So that's where the risk is. And then what will happen? Will they become more mature? We don't know.
Yeah, I mean, it is like almost the economic theory of market efficiency. When everybody has all of the information and everybody is vying for the same good deals, the prices will go up and the returns will go down. When it is not as well known, so real estate, again, there's data information asymmetry. Not everything is known to everybody. Same with cryptocurrency. Not everything is known to everybody. Everything is not public, reported, and tracked for long enough time. Then you may or may not make the best of decisions, which means there's room for making lots of upside, but also a lot of downsides. So higher risk, higher return potential. Okay, the next question. I thought that the AI portfolio tool is pretty cool. Is it not available to the public, you said? Thank you, Andrew. It is not available to the public for two reasons. We are extremely cautious to not appear like providing any kind of financial or portfolio advice. We do have a portfolio manager called Meadowbank, and we work with Rita. So Ron, Rita, we have a panel of portfolio managers who can work with you, but the tool isn't open to public. But we spent a lot of analyses on building that tool. I think we want to be able to open it to public one of these days once we have checked off all our legal requirements to make it public. And the intent is to act as a robo-advisor for the private market. So you can build your private market portfolio a little better than it is. So it uses up a lot of data. How do you find companies that pay dividends? Rita, how do we find companies that pay dividends?
Yeah, so we have an income focused portfolio, so that's more income focused, and that consists of companies that pay higher dividend, and we have a focus on companies that would pay that would continue to grow dividend as well, which is an important component. How would you find it? So I have tools that may not be public. But I think there are public tools available where you can do a screening. Like, say, for example, if you go on S&P TSX and you see all the companies, and then you may be able to sort it by dividend yield. So, for example, you want to see the one that with the highest dividend yield. And some of the sectors, such as real estate, financial services sector, utilities, those are the companies, those are the sectors that tend to pay the highest dividends. So I will start there.
Yeah, so another question is, so to clarify, investing in companies that pay dividends is better for someone with a more conservative approach?
I think, yes, it's hard to make general, very generalized answers, but I think so, yes. And that's the reason why I put up that slide where it shows you what your accumulated dividend will come to over time, and 17 years. You have, in that hypothetical scenario, you have recuperated all your initial cost 100, right? And then you still have the upside and you still continue to receive dividends. So from that point of view, I think it is more conservative. So yes.
All right. Oh, I would love a list of book recommendations for beginners in investing. I want to learn more, but there's so much out there. Recommendations, please. Yes, there is so much out there. I would love recommendations too. What we can do is, between Rita and I, we can share some on a regular basis based on what we read and what we think is valuable. But Rita, I don't know if you have any top of mind book recommendations for beginning investors.
Oh, I have so many. Let me think on it, because I think for beginners especially, you know, I don't really read a lot of beginner books, to be honest, because I majored in finance and, you know, so that's courses and things like that. But let me think on it, and I'll get back to Khushboo and they'll get back to you.
Yes, I mean, anything that you have. The one that we were talking about and discussing is called The Psychology of.
It's a good book. Yeah.
Yeah.
But I think this person may be looking for like something like more how-to, maybe like.
This is what we were talking about. I think I can recommend a lot of side non-investing books that come to me top of mind, which sometimes make you acknowledge that there's a lot of data and analyses that goes into investing, but real life isn't as data backed, and people aren't as rational, and they aren't always making what is a data-driven decision. So I remember when I was reading Freakonomics and studying behavioral economics in school, like that was a aha moment to say, okay, all of this finance education, but at the end of the day, majority of the people are not even making decisions based on rationality at all, even when they have access to data. They're making decisions that make them feel good.
That's true. Yeah.
Yeah. Maybe a better question is, what are the resources you recommend, even online, to help me start investing beyond passive index funds?
Well, there are so many resources. I mean, you'd be surprised. There are many resources through your local bank. So I personally have done seminars at local bank branches, and wherever you bank, I'm sure they're hosting advice events. They're talking about investing one-on-one, tax one-on-one, different things. And you know, seminars like this that's hosted by Khushboo, we talked a lot about investing as well. But I think, yeah, something that's more step by step. I think that actually you've touched an area that may be missing, to be honest. I think there's a gap there. Unless you want to take a first-year uni course, which, you know, no one has time for that.
No, we have in the past, I think, put together something like this for somebody. So I may be able to pull it out, and we can mail it to all of the people who attended the webinar. We'll take that action. We will take Rita Li's recommendations, and we'll make sure you know which ones are coming from Rita Li and not from us regular people. And we'll put together the list of blogs, videos, as well as blogs, videos, podcasts, and books. So whatever medium you are used to. Cool. So Rita, now that we've discussed all of this thing, what do you think is the Canadian the Canadian government's action going to be in the coming quarters? Like, how should Canadians think about their market? Is it going to follow whatever US does, or is it going to have a different path? Are we headed into recession? And how do we make investing decisions based on US data, Canada data? Like, how, if you're thinking in the small Canada subsegment, how do we make those decisions?
Yes. So the Canadian market is actually quite different from the US market. I do think that one needs to have a different strategy. And the reason I focus on dividend investing that in Canada, and that's for that reason, because it does make up 50% of total return in the Canadian market. So you do want to focus on dividend in Canada. It's a different market. In the US, there's arguably more growth opportunities, and it is more tech sector heavy. And the strategy there may be very different. You may want to be more growth oriented, or maybe the best way is to consider a portfolio that has both that complement each other. Take what's strong in Canada, which is resource, financial sectors, and what's strong in the US, and then you combine both, right? And that's something that I do for clients. So that would be I think the second question is on the rates, I think, right? We did have a surprise interest rate hike from Bank of Canada because our inflation was still strong. So you may see some decoupling there. But generally, yes, it's true, because US is such a big economy, it's our biggest trading partner, and we definitely generally tend to follow their footsteps in terms of trends.
Okay, one more question. With the general trends in today's markets, do you see people still on the sidelines with cash, or are they starting to get back into the market? If money is starting to flow back in, that's a good sign of market growth, right?
Yes, absolutely. So there are still cash sitting on the sidelines. Especially the professional people have been very cautious, and for good reasons. Right. So as the market turns and as there's more optimism, for example, earnings revisions have been becoming less negative. And one thing that's important in the public market space is the rate of change, right? So that shows you that inflection point. So yes, it is a good sign for the market. You do just want to be, as always, with investing, cautious.
Yeah. So you are not seeing people getting back into the market yet. You're still seeing them on the sidelines, though, at your end.
Yeah, there's still quite a bit of cash on that's on the sideline, for sure. Yeah.
God. So it's still negative. You're hoping to get less negative.
Yeah, and keep in mind, bonds is a competing asset class as well. One of the things that we look at is bond yield versus equity yield. And equity yield is just a measure of dividend yield as a percentage of stock price, right? So as interest rates go up, bond yield is higher, then it becomes more attractive for people to invest in fixed income, especially for someone that's more conservative, right? And then for real estate, I know there's the cap rate, which measures around the same thing, right? Rental income as a percentage of housing price.
Yeah, yeah. Yeah, real estate, especially residential real estate, I feel like is so emotional that it is very hard to take that and say, okay, I see the data turn or not. I think as a company, we tend to look more at the overall economic data, jobs data, than, because if we are only looking at the housing or residential data, it's just far more emotional than in my mind, a true reflection of the economic situations. So when we are trying to predict macroeconomics, and we use a lot of AI even for our due diligence, we try and look at overall macroeconomics and try and look at overall what the public market is doing, the bond market is doing, and use that in conjunction with the housing price index and real estate indices, for example, to make sure that we're not getting just too siloed into one sector's thinking. Those are all the questions, I think. Rita, any other advice that you would have for, oh, there's one more. The fear and greed index is at extreme greed. Does that mean less room for potential upside? Could you talk about that index a little bit when it comes to timing the market?
The fear and greed index. Is that the index that measures investor sentiment, or are you talking about WIX?
I don't know. Andrew, would you like to speak? I don't know if I can enable him to talk directly. Andrew, I've enabled you to talk if you would like to ask that question.
Investor sentiment. Yeah, so investor sentiment was very, very negative, and that was a contrary indicator. And it was very true, and markets being strong. Now the investor sector, it's more neutral. It's actually start turning positive. So that's where we are.
Yeah, but I think the overall index is tracking toward extreme greed even now, like as of, I think, last week. So I don't know. Do you want to comment on that?
Yeah, I was just curious about the index itself and how reliable it is, or if you ever consider it when it comes to understanding the market's sentiment and then, you know, what's going on in the market. So, because I know Warren Buffett's quote, you know, be fearful when others are greedy and be greedy when others are fearful. And I'm just not sure how that resonates as a, you know, financial advisor.
Yeah, so it's part of the metrics that we look at and monitor for sure. And it's an important one because it does measure the market sentiment. And like I said, it was very, very negative, actually. And now it's starting to turn slightly positive. I have a pretty most recent graph on that, so I can send it to Khushboo after the call.
Sure. And like Andrew, to be honest, I think we at BuyProperly, if you ask me, our mantra is do not try to time the market. We are believers of not trying to time the market, but rather be aware of the market, but do more dollar cost averaging, because timing the market is harder. There are lots of people, including hedge funds and private equity, who try and do this day in, day out. A lot of us regular investors would probably never have that level of sophisticated tools. So we as a company, at least, try to not time the market, but enable dollar cost averaging through smaller investments. So more importantly, you invest small amounts, but on a more regular basis. That way, there'll be some that will do better than the market over time, and some that will do not so great, and overall, you'll be okay.
I agree. Timing the market is hard.
Right. Any other, we have 1 minute to go. So any other parting advice, Rita?
I think we covered a lot of grounds.
I think so too. Thank you so much for sharing your charts, your wisdom, and what's the latest going on in the market. Rita is on our panel of advisors. So if anybody needed any financial advice, She's been gracious enough to help us in the past, and she'll be happy to help our customers as well. So feel free to reach out if you need official financial advice from Rita, and we will connect you to her. We have other webinars coming up as well in the coming weeks. If you found this interesting, feel free to share some of them. They are more focused on doctors and dentists specifically, just because I feel like the healthcare sector is a little underrepresented in investing webinars. And so if you have friends who can benefit from that, share. But thank you so much, Rita. It's lovely to have you here.
Thanks for having me, Khushboo, and thanks everyone.
Thank you,
Great
everyone.
questions. Yeah.
Yes, that was a good session. Thank you. Bye.
Bye-bye.